The number one reason that businesses fail is cash flow problems. What we're not talking about is actually making more money. What we're talking about is when investors don't understand taxes, and then when it comes time to pay taxes, they're upside down on their cash flow. I know the idea of taxes can sound daunting, but in this video, I'm going to give 3 extremely simple tax tips that will hopefully save your cash flow like it's about to save mine. What's up, everyone? Welcome back to the Money Metcon. My name is John Wiener. No relation to Anthony Weiner, thanks for asking. If this is your first time tuning in, I'm documenting my journey to becoming a full-time real estate investor. If that's interesting to you at all, check out this playlist. So let's cut to the chase. When you start making money in real estate, you need to figure out how to pay yourself without paying a ton of taxes. So for the purpose of this video, I'm going to break down 3 different scenarios and give you tax tips for each one of those scenarios. By the way, I'm not a CPA. I think I legally have to say that, so you should actually talk to a professional. Here are the 3 scenarios. 1, rental income. 2, short-term fix and flips, and 3, long-term fix and flips. So rental income. When you make rental income, it is taxed as ordinary income. So in layman's terms, that's essentially the same as you just having a second job. So a simple example is your day job, you make $50,000 a year, and then on top of that, you're making $10,000 a year of rental income. In this scenario, you just add the 2 together, so when you report taxes, you would just report taxes as if you're making $60,000 a year. The key here, and why I love rental income so much, is you don't pay any extra taxes. It's just ordinary income, unlike the next one that I'm about to share. So the second one is short-term fix and flips, which is any property that you hold on to for a 12-month period or less, and there are 2 different categories. Category 1 is if you buy a house and you flip it and you plan to sell it immediately after you're done with the project, you are subject to ordinary income tax, but also self-employment tax, which is key to understand. Self-employment tax consists of Social Security and Medicare, but what you need to know is this adds on extra tax of 15.3%. However, there is a workaround to this exact same scenario. This is scenario 2. Instead of selling the house immediately after the work is done, if you put that house in service, aka you rent it for a short period of time, 12 months or less, you get to avoid the self-employment tax. That'll make you want to subscribe. But seriously, the danger in both of these scenarios is if you are flipping several houses in a 12-month period and you're making a lot of money, you can actually put yourself in a new tax bracket very quickly. So for example, your day job, you make $50,000 a year, but last year you also made $100,000 flipping properties. You are now in a new tax bracket, and you need to make sure you understand what that means. The last scenario is long-term fix and flips, which is any property that you hold on to for 12 months or longer. Now, thankfully, taxes on these properties are very simple. There are 3 different categories that you fall into: 0%, 15%, or 20%. It all depends on how much you make on each one of those flips. Here are the 3 long-term capital gains tax brackets if you want to check it out. Here's the bottom line. You need to be aware of how much money to set aside so that when April 15th comes around, you don't have a Tesla and 5 new projects you're working on, but an inability to pay your taxes. The last thing I'll say is any experienced real estate investor you talk to will advise you right away to hire an experienced CPA who does specifically real estate investing to help you. Don't take this on by yourself. So I hope this video helped. If you want to, subscribe. If not, all good. But what you should do is go buy some real estate.